Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's installation in our Round Table series, we're going to be addressing professional issues for agents and advisors in the infinite banking space. We're going to be addressing juvenile policies. We're going to be talking about legacy and much more. I hope that you enjoy. So let's keep stepping in this direction then. That topic of legacy, let's say through juvenile policies. And I had a conversation this week with my two oldest sons about legacy. And they've heard me use the line, living and leaving a lasting legacy. They hear me talking about it. And one of them asked me, what is a legacy? And I, of course, tried to plant the seed of, well, that's a good name. That's a reputation. That's your work ethic. That is stuff. It could be stuff. It could be property. It could be things that are left behind. It could be many things. It could be a library. It could be. So we had a whole conversation about, and of course they knew the part about property. You know, that wasn't the word that they use, whether they used the word stuff or whatever. But I tried to elaborate more about the other stuff that I felt was even more important. I think it's Jim Rohn that says, you know, if you're not a millionaire and you get $1 million, best you become a millionaire or you won't keep the money. He says it's something along those lines because he's talking about this right here, and this right here talking about you as a person. And Nelson talks about that in the start of the book, right? Like, hey, if all the money went to, an even distribution, before long, it's going to be kind of back where it originally was because most people weren't, a millionaire. But legacy, all right? So when I talked about getting another policy on me, I was telling y'all on a different call the other day that, that makes me consider adding more policies on our children because we currently have policies on all of our children. And I had a guy message me today, actually, on the drive here to the office today. He's like, hey, me and my wife were talking. We want to get a policy on our 14-year-old son. And so let's just have this conversation. Legacy, it's important to me. I know it's important to y'all. Joe, you brought up the concept of juvenile policies. I love guys like I was getting this message from today earlier because he is exhausting himself in material and he's always messaging me. I love those clients. Those are great text messages to get where it doesn't matter if, they're celebrating an anniversary, which is the case here. And I'm just getting to say happy anniversary to y'all. You and your wife, happy anniversary to y'all. And then he's also messaging me about getting a policy. So you brought the topic up. I'm saying that's kind of where I'm at right now. We've got policies on all of our children, but because I've increased my insurability, that means that there is more available for my wife and I to acquire on our children to keep leveling up what we've already begun and established on the next generation behind us. And interestingly enough, and I'll talk more about this soon, we're looking in other directions in the family tree currently where we could get other policies higher in the family tree. So we're trying to spread this thing in all the directions, right? But tell me some of where you're at then, Joe, or you ladies as well.
Well, one, I wanted to comment on that. Like, it's cool to see as you're trying to expand your system, you learn that as your part of the system expands, it impacts other parts. It's what, Jesse's saying about his total death benefit, his insurability is here now, which allows him permission to now expand that insurability on other people in his family. So it's very hard to max out the system, the family insurability because of that dynamic. As the higher branches in the family get more coverage for certain periods of time, that means the whole tree has the ability to get more coverage. So people think they're going to max out their insurability, which is a feat in itself, but expand your thinking and think the whole family. Can we max out the family tree's insurability? That's a whole separate level. Juvenile policies. I was thinking like there's the thought that we buy them on our kids, and I've since changed the phrasing to for the kids, where it kind of puts it into perspective, like we're giving them something bigger than some nominal death benefit that's a burial plot that has like a really negative message to it. It's like where we're putting something in place for the kids. And when you kind of look at it that way, it's hopefully it changes your dynamic and how you approach this. When you look at a policy 20, 30, 40, 60 years into the future, which if you have a newborn and you buy a policy and pay as much premium as you possibly can into the policy, the numbers are staggering 60 years from now.
Yeah.
Staggering. There's thoughts come to mind like how much is enough where you're empowering them with this great foundation, but you're not so much that you take away their ability to buy policies when they're 25 or 30, when those policies can absorb more cash flow, right? As the person ages, that's another way of saying the premium is going to go up per dollar of death benefit. So we don't want to use up all the insurability with the cheapest premium, because then what do we do with the extra dollars? The extra dollars still have the problem that once they're spent, they're gone forever. So we need room in the system to absorb later in life too. So do you put $5 million on a newborn? It's like, well, maybe not. But do you put $20,000 on a newborn? I mean, I think that might be a good starter policy. That probably has some type of rider which allows them to buy more coverage later in life, a few times, 10 times maybe. It's very common. But you could probably find a sweet spot where if the parents are so inclined and understand what they're giving the kids, you could probably find $500,000 is not out of the question. $1 million might not be out of the question once they understand what they're giving to the child, what they're putting in. Like most people's complaints are in the first 5 years. What you're doing is you're wiping those first 5, 7, 10, 20 years away. The child receives it when it's 20 years, 30, whenever you say. There's no actual requirement. Maybe they have to get to a certain maturity, but let's just say 30 years into this, then you hand the keys over. When they pay premium, what does that look like in their world? There is no other option. Like they wouldn't want to store their money anywhere else when they've received that. And to teach them to do the same for their kids and their grandkids. Like the next generation will never deviate from this. If the previous generation handles all the quote unquote suck, the partial liquidity of 5 years.
Well, and Joe, just to be a little bit more specific in what you're saying for people that might not be familiar with what that might look like. I mean, a policy that's 20 years in, you might put in $1,000 of premium and your values go up by 2,000, right? Or 30 years in, you might put $1,000 and it goes up by 3,000. So it really, the exponential curve is really hitting in that timeline. And what a better gift to give to your children is a savings vehicle that is producing that sort of increase. I mean, it's pretty amazing.
A real life thought that I had as you described that, Joe, is I could hear somebody, and you, Becca, you just elaborated on the same thing that I wanted to give a dynamic thought to, which is I recently saw something on my social media where somebody was essentially saying, they're from a small town like I am, hey, we shouldn't have to receive this big inheritance to be able to continue to live in our small town area. And I understand where that's coming from. I can appreciate it. Coming from a small town like I do, seeing how it's growing, developing, changing, okay? And my sentiment right here is not going to be for everybody, but that's fine. I know what I like. And I can understand that and I can appreciate that, but at the same time, like when you said earlier, Joe, that it could be, I think the word you said was staggering growth. And Becca, you're talking about this exponential increase. a part of my mind immediately says, well, yes, but let's look at what's happening in the environment, because if we look at the power of a dollar 60 years ago in the past, and we see that change to today, if we're being proactive, we can have a staggering, controllable, internal compounding, but it's still going to be operational in that overall environment that we're in. So what I'm saying is if the power of the dollar or the amount of dollars that are in circulation continues to be inflated, we better be, if we care, we better be actively and proactively doing something about it so that our children or grandchildren aren't in that situation of saying, well, I don't know. For me, it's a little too much woe is me, and it's a shirking of what I would call a responsibility to do something about it. Personally, at least when you know about it. Now, if you don't know about it, I'm not trying to cast judgment on anybody, but when you know better, you can do better too. Does that make sense? Was that fair? Was that charitable enough? Go ahead, Joe. You're such a polite gentleman. You have your hand raised.
So I wanted to plant this seed out there that this contract over the long term is insulated from that threat. That threat you just described, inflation, or we'll call it atrophy of your purchasing power, atrophy of the dollar. In cash, that exists. When you take cash and exchange it via paying premium for contract value, the contract is insulated from inflation. Dollars also are taxed to the high heavens at every single turn and every transaction. Once that you exchange those via premium for contract value, it's insulated from taxation as well. So you've captured all the economic potential for the child, right? There's no opportunity lost doing this. You've insulated from inflation, and you've insulated from taxation. You've hit the three biggest drags. The maximum potential is the biggest of all of them, even though people think it's taxes and inflation. You've hit all three of them. You've taken care of it with this contract. Like if you do the calculation and say, well, when I pay $1 premium, in 60 years, I might need 5. And I have an example in my, I'm looking at it right now. Let me go down to 60 years. You pay $1 premium. What's the increase? 16x. With a juvenile policy starting at 0. 60 years. So if inflation is 6x, it's still outpaced inflation. The original death benefit started at 500. Now it's at like 7 million. It outpaced inflation.
Yeah.
This product designed appropriately with a long-term view, it creates sound money in a personal economy. It takes all the fundamental systemic risk of the US dollar system out of the equation. You're standing on rock instead of sand. You're doing that for your kid. For them, not to them. Not just on them, but for them. And the future generations of your lineage.
And then I would say the bigger picture, we think too, every dollar that is paid in premium to these insurance companies that don't inflate the dollar is just, that sound money principle. It's just we're participating less. That Nelson's fourth principle of don't do business with banks. We're participating less with that conventional. So we're just positioning ourselves not to be a part of the problem. So we're doing something really great at the micro level, at the me and you level, my family, y'all's families, etc. But at the same time, the more that we do this and more that we encourage other people to vet the idea and to implement it for themselves, then We're that remnant. We're that, peculiar people that are not contributing to that overall problem as well. So I don't know. Tell me some of the pros and cons, y'all. Let's circle back to juvenile policies. Parents already have policies. Maybe grandparents already have policies because, I've got lots of folks that they're the grandparent and they're actually getting policies on their grandchildren. So maybe that means that they're getting a term policy on a child because they're really wanting to focus on whole life policies for all of those advantages on the grandchildren. So let's just talk about the different angles of considerations around the subject. I guess I've had a handful maybe cross my mind since we've brought the concept up. So in general, let's say when considering policies on children in general, a child can be insurable for half of what a parent is. That's one rule of thumb. Now y'all can add anything to this you want. We can calibrate this, but I'm just saying some of the things that I'm aware of, and that would be one. And when a parent's insurability increases, like I was describing for myself earlier, that means there's more available to a child. So then, Joe, you introduced the concept of, well, how's that policy structured? Is it a base-only policy on that child that consumes or acquires more of their insurability, and you have a guaranteed contractual right and obligation to pay that amount? Since it's base, you have to pay that amount, and you typically can't get term policies on children, so we're going to be talking about whole life insurance for the purposes of implementing infinite banking. So not term, whole life, structure matters right there. Is it all base? Is it a balance of both? Some people will say, well, for minors, I would prefer to have more of my total premium go towards base, perhaps a greater percentage towards base, and a smaller percentage towards the PUA rider. Whereas if we were talking about a policy for a 50-year-old, 60-year-old, 70-year-old, they might, and every case is different, but they might want more liquidity. So maybe they would want more of the total premium going to the paid up additions rider and a smaller portion going to the base. So I'm just trying to say some things, and I want y'all to help fill in some of these different aspects, things that have crossed your mind, because these are all considerations. What's crossed y'all's mind?
Well, I'd just like to speak to the limits or the constraints or the, what we have to work with when building juvenile policies. And it really depends. Different companies have different rules. So one of the companies that I write for, they'll let you have up to 100% of the least insured parent. So if dad has 5 million and mom has 150,000, I had a case like this recently. Doesn't matter that dad has 5 million, they can only get 150,000. So that it doesn't matter if it's, like you said, term or whole life. So if the mom wants to apply for a term policy even, then they could get more coverage on them. There's another company that I know of that'll let you have 75% of the least insured parent. You were saying there's some that it's 50%. So there's different rules surrounding that, but just know that there are some limits, and it's for good reason. I mean, they're life from their perspective of the life insurance company. They're thinking, well, why do you want all this insurance on your kid if you don't even have insurance? That doesn't make sense. They want the whole family to be protected and to be covered. And then the other thing that kind of crossed my mind, and this might be going off on a rabbit trail just a little bit, but just the generational nature of blessing when you set these things up. Like for our family, for example, when we first started dipping our toe into this infinite banking thing and was talking to my parents about it and all these things, they had some brokerage accounts. They'd been kind of earmarked a little bit to help with the kids' school for college expenses and that kind of thing. And we kind of talked through pros and cons, like would it be smarter to put policies on the kids instead of this up and down in the stock market? Because what if it's down when they need to go to school, right? We don't have any control over that. And so what we have set up is really, it's a system that spans 4 generations now. So my parents paid for the policies. We're actually the owners, my husband and I. It's on and for our children. And then ultimately the death benefit is going to pay out someday to the 4th generation, to the great grandchildren. And I'm like, that is such a neat to me, such a neat legacy, such a neat story to tell of my parents saying, hey, we have this, we can do something that's going to bless really the next 3 generations and hopefully on past that as we share the blueprint, as we move that further. But, to Joe's point, 50, 60 years down the line, it just looks crazy. The numbers just look crazy. And when you think about, like you were saying, do I want more base? Do I want, how do I want to structure these policies? I think you really have to be thinking long range and thinking like, okay, at that 60-year mark, where this is 16 times a multiple of what we're putting in, you're only going to be able to pay base at that point. So how much do you want to be able to contribute at that time? Will you look back and wish, man, golly, I wish I would have done this differently instead of worrying about what's the least I can pay? Like, think forward, think long range of what that's going to look like in the future, because it's going to make a drastic difference how you set it up today.
I love that. The 4 generations, like the waterfalling of 4 generations, all work. That family tree, like adaptation of this concept. Oh man, it's kind of crazy because there's no other financial product that is designed to do that.
Mm-hmm.
Nothing. Like no 401k. It's all egocentric, narcissistic, self-centered, all about self.
Mm-hmm.
No other thing is designed to go one generation to the next, pay out and be received into the same type of contract, generation after generation after generation. Like you can't inherit an IRA and then move it into your IRA and then pass that to the next kid, and then that's not going to last 10 generations. It's not designed to. There's nothing else designed to be like that, and not lose along the way. So, for example, some people might say, "Hey, I have a stock account that can go to my kids, and they can pass it to their kids." Yes, but your estate's going to get hit with a tax, and there's different rules there. That's like, again, it's not insulated from the tax world.
Right.
It's really so simple.
Yeah.
The dollars are never lost. Every single dollar, and people get all bent out of shape about base versus PUA. Those arguments are rampant on social media. All premium will be reflected in the cash value. All of it, given enough time. Every dollar will be, whether it's base or PUA. Every dollar of premium is insulated from opportunity cost, inflation, and taxation. All of it. So to your point, like, and just to combine the two concepts Becca was saying, there's a limit based on the parents, how much insurability they have. So that kind of puts a cap on how much base you can actually pay. So I find myself looking at like, well, dang, I could pay more, but I'm not allowed to based on these weird rules, which I get. I'm just frustrated because I want more for the kid. But, well, if I can only pay $6,000, I'm going to pay an extra 12 and max out as much as I can pay into this for as long as I possibly can before I hand the keys over. I think that it's different when you have an insurability that you probably couldn't immediately convert to base. It would eat up probably too much of your cash flow. Then there's more decision making that goes into that. But with a kid, I think because of that upper constraint, it's very easy to find yourself saying, okay, buy as much as you can in base, and then how much does that afford me in PUA? That's what I'm going to try and pay. Even though I'd rather have it all be base, or like Jesse was saying, more base than PUA. It's like there's a point where it's like, oh, well, you're not allowed to put any more base, pay any more base premium. And that only puts you at this much PUA premium. That's it. Yeah. Until things change, that's it.
Right.
Now, one train of thought from me right there, Joe, real life, real world, is now that I know what my current total insurability number is, and I've acquired that, part of my thinking in evaluating how to structure policies for children has been, well, okay, I know how much more death benefit they would be entitled to acquire if I did, say, 90% of that. So virtually all of it in base premiums. There are advantages and disadvantages. So I'm just trying to say them out loud just to provoke thought, amongst y'all and for everybody listening. If I pay base only or virtually base only, but still enough to attach a paid up additions rider that would give me some flexibility to pay additional premium above and beyond the base premium, then it would take less of my cash flow because base premium buys more death benefit. So that would be an advantage depending on how you look at it. Okay, so with less dollars, I can actually create this compound curve in the future. And again, companies are different, but if I attach the paid up additions rider, still have the opportunity to pay additional premiums for however long I'm going to be able to do that, and it's not going to be forever. And typically speaking, the more robust that foundation is of the base policy, the more you can pay. But then again, so here's something that tempers that, right, is probably, well, but yes, and then the more paid up additions that you pay earlier on might lessen how many years you're able to do that. So there are a lot of dynamic variables is all I'm trying to describe. And that's why I would always be the biggest proponent that everybody's situation is different. Some things are going to be generally true, and if you're aware of them, they're going to be an advantage to you, but it's very different for somebody to say, well, I'm trying to get policies on my 15, 16, 17-year-old versus my 5, 6, 7-year-old, right? Even that 10-year difference of, well, you might have different liquidity priorities, here in just a couple of years because of a car or moving to college or, whatever. So I don't know, just trying to say more thoughts or more aspects of consideration. Y'all got feedback on any of those or others?
I mean, that's a great point. Like if we put real numbers there and say, if your child is allowed to be underwritten for $800,000, you could buy $800,000 of all base vanilla paying that premium. Or you can go, but you won't be able to add PUA to this. The insurance company won't underwrite past $800,000. Or what Jesse's saying is you may be able to go 90% of that and say, that's base, and I want the ability to pay a little bit in PUA when I can or when I see fit.
Because the policy at application, that's when it's going to matter what they're insurable for, right? Like Nelson famously says in the book, listen, if you start this process, not just get a policy, but use policies for this process, you ultimately have much more death benefit than you originally would have been able to be underwritten for. So I'm saying that while I'm thinking about it. If you got that strong, robust base and still have the option of paying into a paid up additions rider for however much and however long, and you use the policy for the process of infinite banking, I mean, with that coupled with, dividends, it can be so very significant. But at the time of application, that's what I was trying to describe. That's your starting point.
So I'll add a little wrinkle that if we use that 800 example and say Jesse wants 750 because he wants a little space for this dynamic PUA when he sees fit or when he can, he's going to pay into that. That PUA, to your point, buys more death benefit. But at the time of the application, you have to tell them an approximate value. Like they want to underwrite that risk. You can kind of leave it open-ended and just say, put the rider on, and in a couple months, I'll call and be like, how much am I allowed to put in this? And hope nobody's checking the math here. But if someone's paying attention, they could say, oh, we're only up to 800,000. So I just wanted to call that out that even just having a rider on there, you have to you should tell the company if you want to target a specific amount, how much that is, because they're going to add that into their underwriting decision.
Yeah.
If that makes sense.
So would it be fair if I tried to rephrase that and pitch it back to you, that two different philosophies could be, you have a 90% base, 10% PUA, or at least whatever the minimum is to be able to attach a PUA, because most companies are going to have some minimum. Hey, if you're going to have a PUA rider on this policy, here's the minimum, whether that's $120 a year, $10 a month, like whatever the parameter is, right? And then just perhaps real life, you once a month or once a year call or log in and find out, hey, how much could I pay in PUA premium without mecking this policy? And for everybody that's listening, if you want to see a video on, for everybody that's listening, if you want to see a video on what a mech is, I have that in my Encyclomedia channel. Check that out. But that one scenario could be, okay, well, you tell me, insurance company, how much PUA premium could I pay to maximize my policy this year, this month, whenever I'm asking. And I just try and do that on an ongoing basis for as long as they'll let me, right? And then same thing, the child, if they, obtain the ownership, we transfer the ownership to them, they follow that process of paying. All right? But the other way is, well, no, from the start, scenario 2 is, no, from the start, I'd rather just know and go ahead and have an illustration, a starting illustration that'll show me if I paid 60% of whatever premium I'm wanting to pay towards the base and 40% towards the PUA, then it's projected that I'd be able to maintain that amount for the next 40 years or whatever the case would be. Now, that doesn't necessarily mean that you still couldn't even pay additional premiums above and beyond that illustrated 100% that's split between the 60% base and 40% PUA. But all right, so that's me describing two different possible scenarios. Again, Joe's hand is raised, so I'm ready for the feedback. Let's go. We're exhausting ourselves, Joe. We're exhausting ourselves in this. Yes?
I'm ready. Let's go. So you can do this. And I'm not saying you can't. For example, let's go back to let's round this off to $1 million because it's a little easier. If you had $1 million policy and or whatever 900 plus whatever that nominal fee is for the PUA rider. Okay. That's the policy. And you don't tell them how much you're going to put in pay in PUA rider premium. And then 6 months later, you're like, I got a big bonus. How much can I put into this? They have the right to say, you could pay $15,000, Jesse, but we want to underwrite it because it wasn't underwritten when you first put it on the policy. There is no, in the system, there's no capacity that said, you just said you wanted the option, but you didn't tell how much. Because you didn't tell us how much, we have the right to, we don't have the obligation, it may not even happen. But if it gets to a level that no one else knows but them, they might say, whoa, Jesse, we need to underwrite this. This is a bigger risk than we thought it was. Because the death benefit is a risk to the insurance company, right? So written in the contract, they'll say, if it's bigger, if you're putting more premium into this than we expected, we have the right to say, whoa. We want to underwrite that. That just means the medical thing, the medical testing or financial proof that this is not some type of money laundering or something like that. You can do it. And the other way to do it, I think you were highlighting, was to actually declare that number. Say it was $15,000 of PUA premium in a year. You could tell them up front and they'll say, okay, we're going to add that into the underwriting paperwork we're going to do the first time. And when that's clear, you're good. Here's the level that we're expecting in PUA premium. You can go right up to that number. No questions. No one's going to give you any hassle. You could do it for the next 20 years. Ooh, I'm out. I'm bowing out.
Go ahead, Nicole.
Yeah, I just wanted to, I think, clarify because, this is going to be out World Wide Web. We have no idea who might be watching this someday. When Joe is talking about 800,000 million, 750,000, I just wanted to clarify that is death benefit. That is not premium being paid. So that those numbers you're hearing is not money that's being paid into the policy. That is actually the death benefit amount that's being purchased by the premium. The premium is less than $1 million.
Don't limit me, Nicole. That could be my premium.
And that's what's interesting about this conversation, maybe in particular, is because typically we would be talking a lot more about premium amounts, cash value amounts. But because of the context of talking about juvenile policies, we have to talk in the parameters of death benefit on parents or grandparents, and then therefore the death benefit on children or grandchildren, which is interesting. So no, I appreciate the clarification, Nicole. And I'll throw another layer, and you keep going, Nicole. But this is another great reason to be familiar with the company that you're considering, or that you have policies. Be familiar with your particular contract, because just because an insurance company has a rule of thumb, let's say, when it comes to how much PUA, because companies will throw out rules of thumb. And so will agents. I've used rules of thumb. It can be helpful, right? But at the end of the day, be familiar with your contract, your insurance company. And I'm not trying to promote one versus the other. I personally own multiple policies from multiple companies, and the only one that's my favorite is the first one, because it's my first one and it's my oldest one, right? So be familiar with what you have here. Was there any other layers that you're going to add to that, Nicole? And then Becca's next, I think.
I love all of us on this call. Jesse, I don't know about you in particular. You've said you've done this for 10 years, and I know your children are in that age range. For me, since I was older when I came upon this, my first policy I took out on myself. The second policy I took out was on my son. He'll be 24, and like in a week, and a week exactly. Wow. And I took a policy, but the second policy on him, I'm fixing to make the 4th annual premium payment. So 4 years ago, I took a policy out on him. So as we're discussing juvenile policies, technically he was an adult. And even though he lived under our roof still, he was still living at home at that time, the same rules did not apply. So adult children, once they hit that 18 years old, whether they're in your house, they're still your dependent, you're claiming them on your taxes, their human life value for the death benefit they can qualify for is based on their income, which at the time he was just working some minimum wage. Like I could only get a certain amount. So I think it's an important consideration to discuss with clients, with people you're working with, that to get those juvenile policies in place while they can get a bigger policy because of your human life value, right? Which you're underwritten for. Because once they turn 18, it's now all on them. And if they're in college and not working at all, like you might not be able to get much on them at all. So I just wanted to kind of add that little tidbit. The earlier, the better. If you're in a situation where you have a newborn, it's 5 weeks old, right? Most companies at 5 weeks, then you can take a policy on them. So the sooner the better. I just wanted to kind of make that point out there. And that's what I wanted to add.
I love it.
Are you correcting something?
No, he's still got to wait anyway, hand raised or not, because Becca already raised her hand. What you got, Becca?
Well, I'm kind of backing up a little bit. This was maybe to piggyback off something Joe was saying a minute ago, but in regards to the underwritten amount, and maybe this is getting into the weeds a little bit too much, but this is a mistake I made early, because I just thought, well, whatever my MEC limit is, that's how much I can pay. That's not true. So the IRS has the MEC limit. That's their rule. But then the insurance company has the underwritten amount. What did you tell them you want to pay? So the lesser of those, well, you wouldn't I guess the underwritten amount wouldn't be more than the MEC limit typically, but you have to look at both of those. So if your underwritten amount is lower than the MEC limit, is what you've told them you want them to, the risk you want them to assume, then you're kind of leaving some room on the table there. So just be aware that those are two different rules from two different entities that you both have to take into consideration and make sure that you're planning appropriately when you're designing your policies.
So don't stop there for me, Becca. Don't stop there for me. Give me an example. Give me a case study. Walk it out a little bit more for me, please.
Okay, well, I'll give you an example for when I was a brand new agent, right? And I'm gonna blame it on somebody else. I'm sure I got taught wrong. No, I'm just kidding. I take responsibility. I messed up. But I was set with a client. I was like, here's your MEC limit. Here's your minimum. Here's your MEC limit. You can pay up to that. Well, then he puts the policy in place a little further down the road, and he wants to put up to that limit, and we go to do it, and the insurance company says, whoa, wait. We only underwrote it for this amount. It was, it was less than that. That's his limit. And I was like, what? What? Now, luckily, like Joe was saying, it's fixable. You can go back in and say, okay, can we change this? Can we underwrite for more? Can we go back and make a change to the policy? And we approved it, and it got all worked out, but it was such a headache and such a hassle, and took 6 months to do, and that's not the taste you want to leave in your client's mouth. Like, does this person even know what they're doing? No, probably not at the time. I've learned a lot since then, but just be aware that those, maybe you just want those to match. Maybe you want to underwrite up to the MEC limit, so you have all the space in there for PUA that you can have. All it affects is if you have a higher underwritten amount, you might have more medical requirements, and that's going to be the amount that they look at as far as how much death benefit you can qualify for. So on a juvenile policy, if we're looking at half of the parents' insurability or all of the parents, whatever the rules are, you actually can't look at the first year death benefit. I just did one of these. The max they could have was $150,000 on the kids. They weren't looking at the first year being $150,000. They were looking at that underwritten amount. Because when they factor in that you're going to pay PUA, that you're going to pay extra into this, they're actually taking like an average of maybe the first 7 years. So the death benefit might be $150,000 in year 4 or year 5 or somewhere in there. So it's just those little nuances that sometimes this isn't as straightforward. And it's not hard. It's just, you just have to know what you're looking at.
Yeah, there could be a difference between a first year initial death benefit versus what the total underwriting amount is. Because if somebody does pay into a PUA, which is optional, then that's where that total underwriting amount comes into play. Whereas if you didn't pay the PUA, let's say in year 1, because that's your prerogative, then that's why there's an initial death benefit based on the base premiums or maybe also the term premiums that are being paid. Well, I'll say this for you then, Becca, since you put yourself out there and you just shared a real life example of your learning curve. And this goes back to our more professional way of starting out this conversation, talking about this industry, this space of infinite banking. At least that person was able to come back to you in 6 months and you were still there, right? So I'll say that because, and I'm not saying, we're big on not quitting where I'm from, and my children will jump on each other if one of the younger ones says the word can't. The older ones will chime in, can't. Well, they'll say, Josiah said this the other day. He'll say, if you say can't, you never will. That's what he said. If you say can't, you never will. So we can't say that. But that's a real thing. High attrition in this industry, as well as others that I could name. So that's not a judgment. Not everybody should be doing everything. And some things that we start, maybe we shouldn't continue. But also, it's a great boon to be able to have somebody like Becca that you can come back to and fix things and dial things in and level things up, etc. So I'm going to bat for you there because that's just the nature of the beast. All right, are we going to Joe now, or are we going to hold him off a bit longer? Nicole, did you want to say something else instead?
No, I mean, I have, but let's let Joe go.
No, please. My arm's just losing feeling. And go for it. I got plenty of coffee.
Yeah, it'll take us back to what we were talking about before, because I'm passionate about juvenile policies and curious about maybe how you yourselves or some of your clients what their purposes are, right? So maybe it's a little different. One of the things I was kind of running past Joe is I have 5 children still in the house. So we talked about my one son. He's actually child number 4, who's having a birthday next week. But then the 5 in my home, we have 2 adopted children, and then 3 of my grandchildren live with us. And so I'm looking to do policies on all 5. I'm ready to expand the system. Really, it will more than double in size adding these 5 on there, not monetarily, but just in number of policies. Going to go from 4 to 9. So, and I wanted to make it even. The amount of money I'm putting in initially isn't, because it's 5 at one time, is not huge. Probably I had a range, and now I'm at the top end of that range after going back and forth with Joe a little bit and still wanting to maybe put more PUA than base. And now I just love how Joe can put things, because he's passionate about base. And so now I'm like, okay, now I'm looking at something I probably wouldn't have looked at before. What does an all base policy look like? And so now I'm really leaning towards that. So it just takes someone whose mindset's a little different. That's why it's so important to gather, and reach out. So I'm so glad I did. And when to turn the policies over, and I know that'll kind of be different. And once the kids get older, certainly the sooner you start it. And if you've hit that stride by the time they're 18, 20, where you've hit that compounding curve and there's plenty of money in there for them to start a business, get education if they want, buy their first house, then okay, yeah. Or do you plan to keep ownership? With my son, and I've actually taken 2 out on child number 4. We'll just call them child number. I number them. When you start to have more than 3, they just become numbers. I know, Jesse, you have 3, right? So if you add another, they're gonna just start to get numbers. So child number 4. I have 2 policies out on him, actually, and he took a policy loan to start a clothing brand business that actually drops. Today is May 1st when we're recording this. Drops today. It's called See Tomorrow. It's a suicide awareness brand. So I'm really proud of him about that. Anyway, so he can utilize cash value. And of course, I have a contract that he signed and how he's going to be a good banker. But really, my thought process with his policies was I am paying them. So I will utilize it when I'm ready for some passive income at the time. We'll keep being honest bankers throughout until that time where I'm just going to be receiving passive income from the policies. And I really didn't intend to transfer ownership until I graduate. And then, of course, he could take over at that point. It's just base that he's paying on the policies. But then his children will be the beneficiaries, I haven't gone up. There is no up line like before me. My parents are passed. There's nobody. So I've started the system starting with this generation with me, but having them out of my son, so that will then benefit generation number 3. And then once the 3 grandchildren that live here with me have policies, that benefits generation 4. So I love the generational footprint when I realize when I take a policy out on a grandchild, it's benefiting great grandchildren I haven't even met. They haven't been born. That is so mind blowing to me. And really, it's the reason I started practicing this process, was because of the generational footprint I know I can leave behind. It is so important. That is like, it's not important to everybody. I've worked with people that have no children, are not married. Like, I can't even have these. It's not a concept they understand. So then it's like, well, are there charities that you would want to bless? You know, I focus more on the banking function of the policies and keeping it insulated from inflation and the power that has, and tax-free growth and all that kind of stuff. So, but to me, my passion is the generational legacy piece of this.
Well, for the record, I'm child number 2 out of 11. So I have a number from growing up also.
Just wanted to say real quick, what you're saying, Nicole, I think just really reminds me of Proverbs 13:22, where it says, a good man leaves an inheritance to his children's children. And that's one of those verses that I used to read and really felt discouraged, because that felt so undoable. Because, you know, my mindset at the time, I was like, gosh, that seems like a high bar. I hope we can leave something for our own kids, much less our grandkids, right? And so seeing how whole life insurance works and how it can be used generationally, all of a sudden I was like, oh, that makes that completely accessible. We can do that. And so that was a neat realization for me to say, oh, this is definitely doable. We can bless our grandchildren. We can leave an inheritance there, right? And
okay, Becca, you opened the door. You said scripture, so I'm like, yes. I'm like, okay. Even though Joe's touched on it, y'all know I'm passionate about infinite banking and the Lord. So those two things. And then, you know, family and children, stuff like that. But the word of God, I'm like, the last couple of weeks, and I've been reading in the scripture, and the Lord's just really been unfolding. There's a lot of teaching, I think, in churches that we are all familiar with, sowing and reaping, right? What you sow, you reap. What you sow, you reap. But in John 4, again in Luke, don't have the exact address of the scriptures, again in Luke and again in Revelation, it talks about reaping where you have not sown. And so I've been like, okay, this is a little different than what's always being taught, right? There was, okay, what you sow, you're going to reap. Well, no, because not totally 100%. Yes, I believe in that principle. But there's also another principle that I think is a little higher level kingdom thinking, where you're going to reap where you have not sown. And I think that's the benefit of our children, our generation. They are going to be able to reap where they have not sown. And surely they will expand their own personal systems if we're raising them up in this mindset. And in this process, of course, they're going to want to be getting their own policies, and one on their wife and policies on their children. The way Nash expanded his system. David Stearns talks about Nelson, you know, I'd have a child, Nelson would take a policy, I would take a policy. It was like, you know, just every time there was a new addition to the family, and not only did the parent take a policy, but the grandparent took a policy at the same time on the one child. So it was just ever expanding. Just talk about multiplication. But yeah, so there is that concept in scripture that I just want to bring forth, that you can reap where you have not sown. And I believe that's what we're setting our generational line up for.
And that's a great strategy that you illustrated right there in Nicole, to where grandparents and parents can mutually share. It's not a burden, but there is such a thing as capitalizing, right? Policies, instead of just one generation doing that, because person's only allowed so much insurance. So if you could split those premium dollars between, okay, here's our responsibility that we're taking on, here's the grandparents' responsibility that they're taking on. It's just another level of implementing great strategy, and it's also another level of intergenerational cooperation to implement the concept. I think it's always true that more than one thing can be true. I also believe in sowing and reaping, and I also believe that, I guess the example that popped into my mind, because I love talking scripture, so I'll throw this example out there from Ruth. She got handfuls of purpose from someone else, So it's true that as you sow, so shall you reap. But also, God in his abundant grace and mercy and love drops handfuls of purpose to us as well. So I love that you brought that up. Reaping wherein you have not sown. And I think I've said this to y'all particularly before, but if I haven't, I'll say it again. If there were going to be a generation that started something epic, like a private family banking system, part of me could say, wow, that would have been great if my grandpa would have done that. How cool, right? But then another part of me says, well, why not me? Of course it should be me out of everybody that it could have been. Of course it should be me. I'm happy to be doing that. So I don't know. I wrote down a note that maybe we should have Joe make the case for an all-base policy. I feel like that would be something fun to pursue. And I want to hear y'all's thoughts too on when to give policies to children. And I'll say that, for me, I don't have adult children yet. So this is just where I'm currently at in my thinking, right? But I believe a case-by-case basis might be a good way to go. And the advantage that I have, so again, everybody's going to be in different situations, but the advantage that I'm going to have, God willing, over the next several years is that I will get to have intentional interactions more, let me say it that way, because we're already doing things at different levels. I've talked about how our sons now have contributed towards paid up addition portions of their premiums. And then we've made deals with them about, well, okay, you put money towards this, and then Lauren and I have obviously been paying for years already towards their policies, but they're at an age now where they're working and earning money, and we're trying to teach them good things to do with money and things that we could do together. And okay, well, if you pay premium to this policy that's on you, for you, right, Joe, for you, but I'm the owner. I also want them to understand that part right now. Hey, if you do this deal with Daddy, then I'll give you 10% back on your money. If you want to put $100, just to throw a number to it, towards premium, towards your policy, which is something that we just do as a family, here soon, I'll make a plan with you. I'll get you your $100 back in 10%. That way they're learning more about these concepts of policies and paying premiums and making deals, people privately contracting together, all this kind of stuff is what I'm trying to establish, right? And to get them involved. But God willing, what I'm trying to say is that I'll have more years of doing that before they do get to an adult age where they could own a policy, because minors can't own policies. And it's still going to be, for me, where I'm at currently is a case-by-case basis. If this child is doing X, Y, or Z, and I see they're on the right path, I guess my question at that point would be, well, how have we maybe already used money together as a family from these policies? Have they shown me a good track record of, high communication and integrity and just so many things that are important, I feel like, prior to ownership? Yeah. So it's going to be an ongoing process, but that's where I'm at currently. Case-by-case basis. Hopefully we'll have as many experiences as possible where we're just doing stuff together that will predate ownership and more, impetus on their part because they're in that position of ownership, because I'm in ownership right now. My wife's in ownership right now. Did I explain that well? What are y'all's thoughts? Joe's just actually wondering. Here's what's going through his mind right now. He's like, are they actually going to let me talk now?
Well, I would want to hear more. Maybe it's not for this call, on how more about that conversation of how you're allowing your children to pay into their policies, and how I definitely want to hear more about that, because these 5 I'm setting up, 2 of the girls do work part-time, and could contribute. So what
Yeah.
does that?
Well, let me give you two things then. So my second son Josiah walked up to me yesterday after weed eating alone for the first time on our property. We've got an orchard, we've got grapevines, we've got herb garden, we've got a vegetable garden, we got stuff, right? Love our place, takes maintenance. I don't want to weed eat. I hate weed eating. This boy is motivated, right? So I paid him to weed eat yesterday for the first time by himself. And he came up to me when he ran out of gas at one point, and I just pulled my phone out. This is another one of those documentation things, Joe, right? This is another one of those documentation things. I pulled my phone up as he's walking up to me with his safety glasses on, with his earmuffs on, the weed eater in his hands, 9-year-old boy, right? And I asked him, what you been doing? I've been weed eating. Why have you been weed eating? Because the grass needs mowed. Why does the grass need mowed? And who's going to do that? Well, I'm doing that. Well, why are you doing that? Well, I want to earn money. Why do you want to earn money? I want to buy a mower. Why do you want to buy a mower? I want to be able to make more money by mowing. Well, why do you want to make more money? Well, because I want a four-wheeler. And it's like, and then I asked him at some point, well, that sounds like fun. Why do you want a four-wheeler? Oh, we'll do things around this property, and it'll be fun and all this kind of stuff. But I asked him at one point too, was that all you're going to do with money? And we've had enough conversations. We've done a bit together now to where he says, oh no, it goes in the policy first. And before working for money, they got Christmas money, they get birthday money. I mean, kids get money and stuff, right? So for a little while now, I don't know, a year or two, maybe closer to a year, I've had intentional conversations with our sons, because Lana's still young, to where when their premiums are coming due on their anniversary date, let's say, that I have talked with them about, would you like to do something with your money that'll grow it? Would you like to do some business with Daddy? And, we'll take a calculation of what they got right then and there. And I'll say, well, okay, I'll let you pay that portion into your policy. And at this set time, I'll make sure that you get that money back plus 10%. So I'm just going ahead and establishing, I'm trying to establish all these principles of the policy, is priority number one for our cash flow, and doing deals together and all the stuff that I've described. So that's one example, right? And then a client example would be this. I was on the phone last week with a guy who had a young son, earned his first, say, $25,000, I think it was off the top of my head. And he was talking to me about something that you mentioned this earlier, Nicole, also, that when a child, becomes an adult, the insurance company switches gears and says, oh no, you're an adult now. So now we're going to base this insurability off of your age, your income. Well, if you take that 25,000 and you multiply that by, say, 30, because an insurance company, somebody in their 20s, maybe they'd get them 30 times whatever their income is at that age in death benefit. That's 750,000. Well, here's something that's really interesting to consider. If a parent already had $1 million policy on that child, and $1 million in the context of $1 million in death benefit, well, they're already covered more than they're insurable for based on their. So I'm not saying it's a good bad thing. Some people might say it's good. Some people might say it's bad. Actually, I probably would say it'd be good. Anytime you can do something sooner and go ahead and have it guaranteed, I feel like it's really great. I hope that makes sense. Tell me if it doesn't. I'm talking fast right here, and I don't want to lose you. But this client was bringing a son to me saying, hey, he's earning income now. We're wanting to get a policy. This is what we've got going on. And it was the beginning of a conversation between them as well. So there you go. One from my life and one from a client's life. What are y'all's thoughts?
Oh, you've been so patient. I feel like you should have a turn.
Me too.
Please share your thoughts, Joseph DeFazio.
Okay, we have to go all the way back to the mech conversation. Which there were ideas there, but I think we're since past that. I think
Well, write them down. Write them down. Write them down. I've written some other things down, and I'm still tempted, like I said, to make the case for an all-based policy. We'll do a part 2. It'll be interesting.
all right. First I want to go, Nicole. I don't know if you want to share the website or social or handles or something for your see you tomorrow, the clothing.
How do I do that?
Just Or maybe Jesse.
Well, just tell us verbally, and then I can always add anything text wise to the show notes. Thank you, Joe, for saying that.
It's called See Tomorrow, like SEE tomorrow, and they're on Instagram and TikTok at project.see tomorrow.
Project See tomorrow.
Awesome. Yeah, I thought about that when she was saying it, but you texted it, so thank you. Thank you. Awesome.
And so, yeah, it's just geared to get a conversation started. There's 3 dice on the back of the shirt, red dice. It's 135, and that's the number of suicides that happen every day in the United States. And so it's not overtly, but it's a conversation starter. So.
Well, let me do this then as we get to the top of the hour. Y'all know me. We've blocked off 2 hours for this. Y'all have been real generous. I want to give y'all the last thoughts, takeaways. You can preface what we could return to, because we're going to continue the work of the round table. But what would you like to leave folks with from this one?
I think going back to the whole idea of the tension of learning is, as a client, it can be overwhelming to think that you need to understand all of these things we've talked about today. You don't. You need to know what you want to do, what you'd like to accomplish, have an idea, and then have an agent or advisor who knows all these things. It's kind of like when you take your car to the mechanic. To steal an analogy from our friend Jeff Jesse, take a car to the mechanic. You don't necessarily want to understand how all the parts under the hood work. You just want him to fix it so you can drive, right? So don't be so caught up in thinking you have to understand every part. You just need to know how to drive the car, right? And it's just make sure you have confidence and trust in your advisor that maybe they don't explain all these things to you, but you're confident that they could if you asked, if that makes sense. So because you're never gonna know everything your advisor knows, because they're too far ahead of you, right? But the good news is you don't have to. This can work without having to understand all the inner workings and nuances of all these different things that we've talked about today, that can kind of almost create some friction sometimes if you let it. Just trust the process, trust the person you're working with, and you'll have a great result.
Yeah. And I'll piggyback off that also. That was so good, Becca. Because we have gotten into some higher level, numbers and talking about some things that people may get a little lost in. Nelson in his book talks about this process being an exercise in imagination, reason, logic, and prophecy. And I think as a culture, because we live in a very high pressure, high paced culture, we can get caught up and we just need to get the next thing done. And with this process, I believe it really brings in, and Becca mentioned it earlier when she mentioned the scripture in Proverbs about an inheritance to your children's children. We can start to see, we can start to have vision again. And that's probably the most important piece, that's more important than the numbers, for you to start having a vision that only God can fulfill, right? I know for me, it's worked that way because now I can foresee my generational legacy way further out than I ever could before. So let it start there. Start to dream again. Start to let your imagination go wild. The what if I were to do this? What if I were able to really implement a process by which great grandchildren, great great grandchildren would benefit from what I do today? Yeah.
And I will keep in that same vein. And I kind of want to just encourage people looking at this, what you're giving your kids and future generations. I can't understand the benefit of a sound money system. Sound money changes all the math. The math that works, that we're all kind of used to using in this atrophying world, it doesn't apply. As you're learning this in that tension, as you're learning and going through this material, you're trying to apply those concepts and principles to this, and it doesn't work. It's more akin to you learning to ride the bike for the first time. You never did anything like this before. You may have seen circles before. You may have seen people on vehicles before. It kind of looks vaguely familiar. You can't measure it and learn it the same way that you applied to most other things. It's brand new to you. The actual contract is very, very old. The concept is very, very old, but you have never come in contact with it like this. When you build this generational foundation or juvenile policies, you're gifting not just the numbers on the page that you're trying to look at. You're gifting sound money principles to the next generation. And all the things Jesse and Becca and Nicole were talking about as they guide the next generation to learn those principles. The blueprint with sound money dwarfs anything you can do in an atrophying world. When you're looking at it like that, the gift you're giving, hopefully that gets your juices going. Hopefully that motivates you and thinks bigger than you may have thought of. Oh man, what's the smallest I can do to get this benefit? Expand your thinking. Don't be afraid to expand your thinking. That's all.
All right, well, that was an absolute pleasure for me to have that conversation with my friends here at the round table. Here's what I would appreciate from you. If you are the new person, let us know in the comment section below what you would like us to address next that's going to best help you. If you enjoy going into the deep waters because you've already been implementing infinite banking, then also let us know what your biggest takeaway was from this conversation, or what you would like us to address for you in the future. My hope is that you do live and leave a lasting legacy. Everybody's contact information is going to be below in the show notes. Have a great day. Take care.
Did I lose the
audio? Did I lose
Did
you? Is my Bluetooth acting up?
We can't hear you.
Goodness.
Jesse, we lost you, man. It sounded like a good point, though. You had me go. Yeah.
Let's see here. Ridiculous. Ridiculous.
Ah, the chapstick. Where's the coffee? Get them powered up.
Ridiculous. Y'all still can't hear me? Nothing. Nothing.
Mm-mm.
Nothing. Nothing.
Nothing.
Still no.
Nothing. Negative.
Okay.
You're gonna have to go old school and get a
Well, I was
boomstick.
talking, so at least that camera's gonna happen. Let's see. Let's see what this does. Yeah. Where'd you lose me? Tell me. I don't even know, of course, because we couldn't talk.